and good afternoon from Accra, and good morning to our colleagues in North America. Thank you very much for making time to join us on this afternoon's webinar. And we see we have over 60
Hello.
strong participants online. Hello? Okay. So we have over 60 participants online now to hear from IPA on this interesting research work they've done. And to take us through that conversation, we have William Blackmon, who is a senior research manager for IPA's Financial Inclusion Program, where he oversees a portfolio of research studies, including work on mobile money agents, networks, and consumer protection for digital finance users. He has been on the field very active on this research, and he'll be taking us through what the outcomes of this research has been. Then we have from the Institute of Statistical, Social, and Economic Research, Professor Peter Quartey, who serves as the director of the Institute, as well as the executive director of the Retail Finance Distribution Research Initiative, a sub-grant awarding initiative looking at supporting agents networks to extend to last mile communities. Previously, he was the head of the economics division of the Institute, as well as the head of the Department of Economics at the University of Ghana. We also have with us Edwin Salema, who currently serves as an analyst and programmer at the Bank of Tanzania, specializing in national payment systems. Aside this, Edwin has a rich background in technology consulting services. For this webinar, he'll be taking us through, he'll be sharing insights from the regulator's perspective on the issue of transaction costs. Then finally, we have with us representing the supply side or commercial providers, Alex Wekoye, who serves as the Chief Commercial Officer for MTN Mobile Money in Uganda. Before his time at MTN Mobile Money, he served as the Chief Commercial Officer for Digital South Sudan and the Chief Marketing Officer for Easy Agri. So Alex comes with a lot of insight on the cost and pricing of digital financial services, especially to underserved and underreached communities. So once again, to our distinguished speakers and panel, welcome, and thank you so much for making time for this engagement. And to our audience, these are your speakers, and we look forward to a very engaging conversation. This is Insights from the Field on Transaction Costs, and this is a learning platform, and we encourage you to be very engaging. You can ask questions using the Q&A tool, which is towards the bottom of your screen. You find a Q&A icon. You can click on it, and whilst the conversation is going on, if you have any questions, please do type in your questions in the Q&A, and we'll make sure it is answered. Nonetheless, we'll have time for you to ask questions directly if you want to do so. All we need from you is to be very engaging. So to kick our conversation going, would want to invite William to take us through the evidence from the field. What is the evidence from the field in the area of transaction costs? So, William, you're welcome.
Excellent. Quickly confirming that you can both hear me and see my screen.
Yeah, I can see both. I can see you. I can hear you.
Perfect. Wonderful. Well, thank you so much, Adez, and hello, good morning, good afternoon, good evening. Thank you all for taking the time to join us for this presentation and what I'm sure will be a very engaging panel to follow. And thanks to all of our panelists for participating, and a special thanks to ISSER and in particular Adez and Professor Quartey for their leadership in putting this event together. So I'm very happy and very excited to be sharing the work from Innovations for Poverty Action's Transaction Cost Index, where, as Adez mentioned, we are seeking to understand the experience of mobile money and digital financial service consumers, and in particular to measure the cost, the true cost that consumers face when using mobile money. Along with the team at Innovations for Poverty Action, this work is led by Jabi Jine at the World Bank and Francis Annan at the University of California at Berkeley. So I'll begin by providing a bit of brief motivation for this work, then describe the field work that we carried out, including a discussion of the various methods, research methods that we used, and then I'll dive into the results and our findings. Okay, so introducing the transaction cost index, I'll begin with a bit of motivation. And you know, to begin, we know that there is a very strong body of evidence that links digital financial service usage, and in particular mobile money, to improvements in users' welfare. And we know that this exists through a number of causal channels. For example, mobile money can improve consumers' ability to access geographically dispersed social networks for support in the case of emergencies or sudden need for funds. And mobile money also allows consumers to shift to higher productivity employment, including potentially migrating to urban centers while maintaining the ability to easily and quickly send money home. So the connection between digital financial services and welfare improvements are well established. What is a bit more complicated and less well understood is the connection between all of these things that you see on the left and usage of digital financial products. So the question is, why do consumers not universally use mobile money and other digital financial services despite the benefits? So if we back up and we think about how consumers are making the decision to use mobile money or not use mobile money or other digital financial services, we see that it's a complex decision with many components. Digital literacy is a necessary component, as is trust in financial systems. The products also need to meet the needs of consumers, and infrastructure needs to be in place to make mobile money valuable to consumers, which includes both the physical infrastructure, you know, cell phone towers and things like that, but also the human infrastructure in the form of a reliable network of agents where consumers can make transactions. Finally, we know that costs are an important contributor to the decision of consumers to use mobile money. We know from basic economics that as prices go up, demand will go down. In our case, we think of costs not just in terms of official prices, but also extra informal fees and non-monetary costs can also matter. So the transaction cost index and the work that I'll be discussing today doesn't address all of these various drivers of digital financial service take-up, but it focuses in on really two. The primary one is cost. We try to measure costs in a truly comprehensive way. And we also measure some things related to infrastructure, particularly around agent network reliability. So as I've mentioned, the transaction cost index study aims to measure the costs consumers face when making mobile money transactions. Just briefly, most of our work was conducted in Tanzania, Bangladesh, and Uganda. And as I've said, we're focused on measuring both monetary and non-monetary costs. Although our work at the moment, in terms of field work, is limited to Tanzania, Bangladesh, and Uganda, we view this as just the beginning, with a focus on developing a methodology or a set of methodologies for measuring these costs in a systematic way. And we hope that the work that we are doing now can be put to use on a larger scale to measure costs across a broader range of geographies across a longer time period on an ongoing basis. So we have two basic research questions. The first one, what are the leading hidden costs that consumers face? So not just official fees, but informal, illicit fees charged by agents, as well as non-monetary costs related to price transparency and agent reliability. How common is it for these consumers to face these challenges? And then what sort of differences do we see in terms of the way that we collect the data collection method, as well as differences by country, by geography, by consumer gender. Okay, so what did we do? We have four basic components of this. And starting from the left, we conducted a desk review of official fees across a broad range of countries and a broad range of financial service providers. So we visited providers' websites and we scraped information about the official fees from this set of 16 countries and I think 31 different financial service providers. So this was desk work only, and this was done on a broader range of countries. And then we did field work, as I mentioned before, in just 3 countries, in Tanzania, Uganda, and Bangladesh. And we tested out 3 distinct approaches to measuring costs, including informal, non-monetary costs. The first one is a relatively straightforward one, consumer intercept surveys, where we placed our own enumerators outside of agent locations and asked consumers after they had gone to make a transaction about their experience. So we asked, number 1, were you able to complete the transaction that you were attempting to complete? And if so, how much did you pay in fees? And then we compared those fees to the official fees to understand the rate of any overcharging. Second, we conducted mystery shopping. And by mystery shopping, I mean sending someone in to make a real transaction predetermined by researchers and recording the outcome from that mystery shopping visit. Again, what was the transaction? What was the outcome? Were you successful in completing the transaction, or did the transaction fail, either because the agent was not present or the agent was unable to complete the transaction for a variety of reasons? So we did that mystery shopping first with trained enumerators employed by Innovations for Poverty Action. And then finally, our last approach was also mystery shopping, but instead of using trained enumerators from employed by Innovations for Poverty Action, we instead recruited a set of local consumers who lived and worked in the areas where we were conducting our field work, and we trained them to become their own mystery shoppers to complete these similar transactions. As you can see, we had relatively high sample sizes, around 2,000 to 4,000 visits in total across the 3 countries, I should say. Okay, so let me dive in a bit more detail on, first off, the desk review process. So I said we carried out this work in 16 countries. You can see it is here. It's concentrated mostly in sub-Saharan Africa, but with quite a few examples from Asia and Latin America. So what did we do? We went to the leading mobile money providers in each market, normally 1, 2, or 3 leading providers in each country, and we found their websites. We sent our own team of researchers to visit each website for each of these leading providers, and we searched for the price lists that would, you can see an example here. I think this is from M-Pesa in Tanzania, or possibly, yes, in Tanzania. So found the price lists and then scraped that data using automated methods that allow you to download the data that's found on these websites, and then converted them into a standardized data set that allows us to make comparisons. For example, you can see here, this is a comparison within Tanzania between the 3 leading providers, Airtel, Tigo, and Vodacom M-Pesa. So then now let me shift from desk work that we did, where we downloaded and compared official fees across this broad set of countries, to our field work, which again took place in Bangladesh, Tanzania, and Uganda. And again, we had three methods. We asked people, we conducted consumer intercept surveys where we asked real consumers about their experience. And then we did mystery shopping by trained enumerators and by local consumers. So what I want to do now is spend a bit of time comparing the methods, those three methods, in terms of these five dimensions, in terms of affordability, adaptability, reflection of real world consumer decisions, data quality, and what we call observer effects. Once I'm done with this, we'll move on to the results themselves. But we feel like this is very important because, as I said, our goal is really to develop a strong method. And what we've seen is that there's pros and cons for each of these methods that's worth considering before diving into the results themselves. So looking at affordability, or the cost of collecting this data, you might expect that professional mystery shopping, engaging with professionals, would be the most expensive method. But in fact, that's not what we find. Here you can see across the three countries, the trends are quite similar. What we see across all three countries is that consumer intercept surveys are by far the most expensive, and then mystery shopping is less expensive. And in fact, professional mystery shopping tends to be slightly less expensive than local consumer mystery shopping. Why might this be? Well, the fact is that in most of these countries, particularly in rural locations, agents are not particularly busy. There's not a lot of consumers that are coming and making transactions at any given time. And so when you want to run a consumer intercept survey, you spend a lot of time waiting for consumers to appear. And so you have your enumerators, and they're sitting and they're waiting, and that costs money. And so spending time recruiting actual consumers to carry out surveys can end up being quite expensive. And so using professional mystery shoppers ends up being the least expensive. When we think about adaptability, we think about the ability to define exactly what types of transactions we're interested in measuring. So for example, maybe we are concerned most with cash out transactions when you're withdrawing funds from your account. And if you're conducting mystery shopping, you're able to focus in on only that type of transaction, versus consumer intercept surveys are less adaptable because you must use whatever transaction consumers are actually using in the field. Reflection of real world consumer decisions is in some ways the opposite of that. In this situation, consumer intercept surveys are the best because they reflect real decisions that consumers make. So for example, if consumers know the best agents that they want to visit, the ones that are least likely to, for example, discriminate against them, then measuring using consumer intercept surveys will take that information into account in a way that professional mystery shoppers, where we assign consumers to make transactions at particular agents, which is a bit different. Yes, which I've summarized here. Finally, not quite finally, second to last, data quality. So of course, we are interested in measuring these outcomes accurately, and so data quality is important. And you may be concerned with consumers' ability to accurately record outcomes such as overcharging, perhaps because of a lack of knowledge about the fees that they are actually paying, or a lack of an inability to remember exactly how much they paid. And so we can actually measure this very concretely. What we do here, and what this graph shows, is the level of consistency between the official fee that the consumer that we find on providers' websites with the official fee that the consumer, or the mystery shopper or the consumer, tells us that they paid. Because we ask them not just how much did you pay for this transaction? We ask them, how much did you pay in official fees, and how much did you pay in excess informal fees? And so we know that that official fee should match with the website. And so what we can do is we can compare the three methods in terms of consistency, where we would, a higher consistency rate implies stronger data quality. And what we see across the board is that professional mystery shoppers are quite consistent, so the data quality there is high. Local consumer mystery shopping is also quite high, except in Uganda, where it's dramatically lower. And this is because of a particular quirk in our data collection in Uganda, where we utilized a different survey method and then adapted and removed that in Tanzania and Bangladesh and saw improvements. So overall, what we find is mystery shopping results are quite consistent, while consumer intercept surveys are significantly less consistent, which would make sense because consumer intercept surveys, we're asking them to tell us about the fees that they paid without training them in advance. And so you would expect that mystery shoppers would be a bit higher quality. Finally, observer effects. Observer effects or Hawthorne effects describe how respondents, in this case, agents, may respond differently if they know that they are being observed by researchers. So in our case, there might be a concern that agents, mobile money agents, might notice that we are conducting a research study, and normally they overcharge, but in our situation, they say, we won't overcharge, we'll follow the rules, because they recognize that they're being observed. What we find is the professional mystery shoppers are the most likely to encounter this observer effect, because enumerators who are hired by Innovations for Poverty Action are obviously outsiders outside of the communities where we work. And so it's easy for agents to detect that something different is happening. And so although professional mystery shoppers have very high data quality, there's concerns around observer effects. Local consumer mystery shopping is still somewhat of an issue, whereas consumer intercept surveys, where it's normal transactions that a consumer decides to make on their own, this is much less likely to encounter observer effects. Okay, so I've described the three fieldwork methods as well as the desk review process that allowed us to access official fees. And I'll take what we learned from both our fieldwork and our desk review process, and I'll talk through a few findings. And I'll break this into three broad groups. First being price transparency. Are consumers able to access information about what the prices should be? And then I'll move on to monetary costs, the direct monetary costs of making transactions. And finally, I'll focus on non-monetary costs, and in particular, reliability. So as I said, first off, price transparency. Are consumers able to access information about prices in a way that makes sense to them and is understandable? And what we find is that there are significant gaps here. Prices for mobile money transactions are not always easily accessible to consumers. And we have findings here both from our desk review work and our field work. So in terms of our desk review, where we visited providers' websites and looked for price lists, the good news is that we were generally able to find provider price lists on their websites, with a few exceptions. There were cases, particularly in Nigeria, for example, where price lists were not easily accessible. However, these price lists can be difficult to find. For example, in 1 in 3 cases, providers don't have a link to their price lists on their homepage. So you have to dig around within their website to find this price lists. We also see that regulators typically require that prices are made available to consumers, but are often silent in terms of exactly what locations and what channels they should be available to. So there may be opportunities to specify with a bit more detail exactly what is required of providers in terms of making their price lists available. So then we shift from our review of websites to review of our fieldwork data. the first thing that we did, I didn't mention this earlier, but when we conducted our mystery shopping visits, before we even attempted a transaction, we looked at the agent location to see if there was a poster that has the price list for common transactions, which is typically required in the countries that we worked in. And what we find is that in Bangladesh, nearly 100% of agents have their price lists posted. In Uganda and Tanzania, it's less consistent, though. It's more than 50%. So in Uganda, 59% of agents have these price lists posted. In Tanzania, 82%. So generally good news that price lists are often available. Now, price lists are great, but verbal disclosure of prices from agents is even better, particularly if you have limited literacy or your eyesight is not so good and you're not able to see the poster in the back of the room. Agents ideally should tell you the price of a transaction before you make the transaction. Just as if you go to the store to buy oranges, they'll tell you what the price of the orange is before you purchase the orange. We see that this is quite uncommon. Less than 10%, 12% in Uganda, but typically 10% or less of our cases does the agent ever tell you verbally what the price will be of a transaction. So we find overall that price transparency is quite limited. Let's move to the second topic, which I said was monetary costs, the direct monetary costs. And again, I will focus in first on our desk review results, which include just the official fees and not any overcharging. So what I've done here is I've displayed the average cost, and here we take a representative reference value, which is approximately the median transaction size in each country. And I look at the fee, the official fee, inclusive of taxes where applicable. And I display this as a percent of the transaction amount. So if you make a $100 withdrawal and you're charged $5, that would be a 5% fee. What we see here is, number one, deposits or cash-ins are rarely have fees, with the exception of Cote d'Ivoire and Nigeria, versus withdrawals have quite significant but highly variable fees. So we see many countries where withdrawals are free, but we also see cases where withdrawals can be approaching 10%. In Tanzania, it's 8.3%. I should note that there's been a lot of change in Tanzania, as our Bank of Tanzania representative I'm sure will mention, and there's been a significant reduction, particularly around taxes. And so this represents data from 2022, and in fact in Tanzania the prices have gone down. We also look at person-to-person transfers on network, meaning sending within the same provider, or off network, sending to a different provider. And what we generally see is that these costs tend to be lower than withdrawals, and off network transfers tend to be a bit higher than on network transfer fees. Finally, as I mentioned before, we separate costs between provider fees and taxes. And we see that in a few cases, with the particular focus of Tanzania, the taxes can make a quite significant component of the overall fee. Okay, so I'll shift again from our desk review process, which collected official fees, and I'll shift back to our fieldwork, where we conducted mystery shopping and consumer intercept surveys to measure the prevalence of agent overcharging. And what we see is that agent overcharging tends to be quite high in Uganda and less high in Tanzania or Bangladesh. This tells us the proportion of all transactions in our study that incurred any amount of overcharging. So in approximately 1 in 5 transactions in Uganda, there was some degree of agent overcharging, where informal illicit fees were charged, 7% in Tanzania, 5% in Bangladesh. Now, where does this happen? It turns out that this is really driven by cash outs or withdrawals. So this table shows column 2, frequency, tells us that most agents are performing primarily cash-ins and cash-outs. This makes up about 80% of the transactions that they make. Over-the-counter transfers are also very common, where a customer will come with cash and ask that that money be sent elsewhere, and then all other types of transactions represent only 6% of the transactions that agents make. So then if we look within each of these main categories, what is the overcharging rate? We see that cash outs, 16% across the 3 countries, 16% of cash outs end up with agent overcharging versus only 1% of cash ins and 7% of over-the-counter transfers. So it's really cash outs where we see overcharging occurring. Okay, so what types of transactions are at risk of overcharging? Here we don't see a very consistent trend across countries. It tends to be quite different by country. But a few outcomes that we see here that we find interesting is that urban consumers in Tanzania specifically are more likely to be overcharged by an agent than rural consumers. So we see that only in Tanzania, urban consumers are more at risk of overcharging. In terms of the transaction size, we see that higher transaction values in Tanzania are more likely to be overcharged, whereas it's the opposite in Uganda. Larger transactions are less likely to incur overcharging in Uganda. We also, as I mentioned at the beginning, we were very interested to look at any differences in overcharging by customer gender. And in fact, we find no significant difference there in our work. So let me turn to the last of the 3 categories of our findings. So we talked about price transparency, we talked about monetary costs. Now I want to focus on non-monetary costs, and particularly on this issue of agent reliability. We found that this was a significant challenge. And in fact, overall, approximately 1 in 3 attempted transactions were not completed, either due to the agent being absent or transaction failures. So we can see across the 3 countries, there's some variation, but we see that between 15 and 24% of attempted transactions fail because the agent is simply not present, even though we visited during normal business hours. And then we also see that transactions are commonly fail, even if the agent is present. So between 11% in Tanzania and 18% in Uganda. So this overall, shows that many transactions that customers attempt to make are not successful. Sorry, which can cause serious issues for consumers. Again, if we try to split this by demographic characteristics, we see that urban agents tend to be more reliable and smaller transactions tend to be more likely to succeed than larger transactions. So why do these transactions fail? Besides the issue of agents not being around, we know that that's one leading cause. What is the other, if a transaction fails, even though the agent is present, why is that the case? And we see that the leading reason for this is liquidity, meaning agents don't have the cash on hand or the money in their digital account to be able to complete the transaction. This overall tends to represent about half of the reasons for the transactions to fail, versus other issues like network reliability does not seem to be a leading cause of this. So I think we have a poll available. Lauren, is the poll ready to go? We wanted to get a bit of engagement. Okay, so don't vote yet. Let me explain this question. So it looks like, okay, you can answer both questions at the same time. So what we did is we calculated the average time across the 3 countries to complete one successful transaction, incorporating this issue of reliability. So what we did is we said, what is the travel time, from your home to the agent location? and taking that into account, as well as taking into account the likelihood that you may go and attempt to make a transaction, it fails, and you have to go home and try again on another occasion. So taking all of that into account, what is the average time across the 3 countries that it takes consumers to complete one successful transaction? So that's the first question. The second question, what we did is we converted that time cost, the time to complete a transaction, to monetary terms. We used average wage rates in each country, and we converted the time in minutes to a dollar figure in USD. And then we compared that to the direct monetary cost, the cost of completing a transaction, both in terms of official fees and non-monetary fees and unofficial fees. And so then you can compare these two, and you can say, well, what is actually more expensive? Is it the time cost, or is it the direct monetary cost? So I will give you 30 seconds to vote on both of these questions, and then I think we can display the results. Lauren, can you confirm we're getting votes, and if we've gotten a sufficient number, can you display the results?
Yep, we are just about to hit half of the participants, so I'll give everyone another like 5 seconds, and then I'll show the results.
Excellent. Okay. So overall, it looks like we're seeing that many people are voting that the time cost is relatively short, in the 0 to 15-minute range, though we do see that a few people are saying all the way up to 45 minutes. And then on question, well, let me provide keep displaying the results, Lauren, if you don't mind. So let me display the true results that we find here. So we find quite significant average time costs between 31 minutes in Tanzania up to 40 minutes in Bangladesh. So the time cost is quite significant, really driven by this issue of limited reliability. Okay, so question number 2 is on is the time cost or the monetary cost the leading issue? And we see that many people, 63% of individuals, say that time cost is the more significant issue. And in fact, you're right. This is true. So what we see is that the time cost here in converted to USD varies from 31 cents to 69 cents. When we compare that to the monetary costs, which includes the official fees and the overcharging, it's significantly less. It ranges from just 7 cents to 19 cents. So it's like more than double in most cases, the time cost. And so, the conclusion here is that reliability seems to be a larger issue than the issues of monetary costs when we think of consumer welfare. And in my last couple of minutes here, I want to display some interesting results that we did similar to this poll that each of you have answered. We asked experts in the field. So these are individuals in the regulator space, in the research space, in the commercial private sector space, about these outcomes. So we asked them 3 basic questions. One about transparency, level of pricing transparency, then about reliability, then about agent misconduct or overcharging. And so let me go through the results, because it's a bit interesting here. What we see first, we asked what % of agents have their price lists posted. And so what we can do here is we compare what the experts told us versus what we found in the field. And in terms of pricing transparency, we actually found that the field work tells us that transparency is better than what experts predict. Experts predict that just 59% of agents will have the price list displayed, versus in the field, we found that 80% did. So actually significantly better than predicted. We know that there are transparency issues, but perhaps they're actually not quite as bad as the experts would predict. Then we turn to reliability. The success rate, unconditional success rate, incorporating both agents being present and failed transactions. Experts predict that 72% of attempted transactions will be successful. Our fieldwork shows 66%. So here, experts were quite accurate, really. They were a bit too optimistic. Reliability is a bit lower than what the experts predict, but only marginally so. And then finally, on agent misconduct or overcharging in particular. So the overcharging rate. Here we see a very stark difference where experts predict that 1 in 3 transactions will be overcharged, but our fieldwork showed that, in fact, overcharging is much less of an issue. Only 10% overall of transactions involve any overcharging by the agent. So this helps us to sort of recalibrate which issues are most pressing, and our overall finding is that transparency is an issue, though not a huge issue. Reliability is a larger issue than experts predict, versus overcharging is a smaller issue than experts would predict. I know I'm out of time, but let me just quickly go over what's next for us. You can please feel free to reach out to our website and download our year 1 report, as well as country briefs for each of our 3 focus countries, Bangladesh, Tanzania, and Uganda. You can also access our underlying data, which we've provided in the form of an interactive dashboard. We'll also soon be launching a year 2 data collection report. We've completed data collection and we're finalizing the report. We'll also be producing a toolkit meant for regulators and financial service providers that describe each of these methods in more detail and the pros and cons for each. And then, as I mentioned at the very beginning, we really hope that this can just be the beginning of the transaction cost index, and periodic ongoing data collection can eventually be established, so over a larger set of countries. So if this is interesting to you, if you in your country, you feel like this would be a valuable thing to do, please reach out, and we'd love to talk more about the future of this data collection. So with that, I will conclude. Again, please feel free to reach out if you have comments or questions, and I will turn it back to Adez.
Great job, William. That was really insightful. You've managed to really humanize the data, bring it very close to everyone's understanding. So we'll transition to the next stage, which will be to listen to our panels from academia, from policy, and also from commercial solution or commercial providers, how they see this data, how they see this tool, and what impact or how they can take it forward from their perspective. So let's begin with Professor Peter Quartey. So Prof, you are a leading voice within academia, especially in the Global South, where you continue to advocate for the need for regulators, for policymakers, for industry practitioners to integrate evidence in their work, to engage academia in using evidence for policy and action. Listening to William, how do you think regulators and policymakers, as well as industry practitioners, can use this tool? What can they use it for? How can they use it? And also, maybe let's take this one, then we'll come to the next one. So for the first one, we want to hear from you as a leading voice here. How do you think policymakers and industry practitioners can use this tool and the evidence coming out of the tool to inform policy and practice in the area of transaction costs? Professor Peter Quartey.
All right, thank you very much. Greetings to the panelists as well as the audience, and thanks, Rosalie. I find the presentation and the analysis very rich. I am particularly quite struck by some of the key things that was presented. We find that transactions cost overcharging, issues about transparency is quite a challenge in our part of the world, and we find this troubling because digital financial services provides the key to employment, provides the key to productivity, innovation, helps in welfare improvement. So if this is not happening because of cost, then it becomes a source of worry. I personally think that listening to the conversation, the presentation, that the need for disclosure is very, very important, and therefore regulators should look at this carefully, provide a framework that will guide as much as possible. And we can find evidence of some of this in our country. So in Ghana, we find the Bank of Ghana disclosure and transparency directives, which is in the draft stage and ought to be developed. But in that policy, one of the objectives is to protect consumers of digital financial services and products by ensuring that institutions that provide these services do so in a transparent and fair manner by disclosing to the consumers and prospective consumers all the information that is necessary to enable consumers make informed decisions. We can find same with the Ministry of Finance, Financial Inclusion Policy, and many other policies that you find in Kenya and other countries where there are attempts to minimize some of these problems. But the issue is about enforcement. The issue is about making it more transparent, providing the information that is quite needed. So this clearly shows the need that regulators should provide the framework, the platform, and also not just the policy, but should enforce and ensure that agents and all those in the value chain provide or undertake whatever they commit to do.
Thank you, Professor Quartey. And just a follow-up, listening to William, do you think there are areas of improvement or expansion when it comes to the tool? And if you think there are areas to expand this tool, how would expansion be beneficial to the research community or to academia moving forward?
Well, one, in every tool, one would like to find the fine details. So I think one of the things the researchers could do is to tell us the methodology, go a bit more detail to the methodology. In terms of the sampling, one will wonder, was it a random sampling or was it purposive? You want to engage more on that, because oftentimes when policymakers or practitioners do not want to use your tool or information, they look at your methodology carefully, and it has to be rigorous, it has to be sound, it has to provide all the needed information. So I think that's an area that we need to work on. Then also the coverage. With empirical work, it was 3 countries. But then if you look at the desk review, they did about 16 countries. Perhaps it's about time to expand this across the Francophone, Anglophone countries. You can do sub-regional analysis and I'm sure there will be a lot of nuances, there will be a lot of differences to cover. So that for me will be one critical area that ought to be looked at. I say this because when as a young researcher 20 years ago, I tried to delve into this area where I looked at MTN and compared it with Tigo and a third operator. I looked at their prices because there was little transparency, disclosure, prices were not shared. So I went with a survey questionnaire, collected data on their prices, and as well as how much they were charging per unit using the cost. And I realized that one of them, which was a dominant player, had a higher price than the others and published this they came strongly to challenge what I presented. But in all, it helped because it then opened doors for transparency. I mean, if you disagree with my data, then provide the right data. And that gradually made them come out and provide more data. So I think that's an area where we can do more disclosure. Disclosure from the service providers themselves, their terms and conditions, monitoring and providing oversight as much as possible, so they could use all the tools available for disclosure. Providing feedback is not just disclosure, but they should provide feedback. They should adopt technology, appropriate technology that would send signals. Can you hear me? Hello? Hello?
Yes, we can hear you well.
Yes.
I don't know whether I'm losing it from my end or it's from your end. Yeah.
Yeah. So I was saying they could adopt technology, so SMS alerts, mobile apps, and also ensuring some compliance with regulatory standards. Regulators should ensure that the providers adopt to some of these technologies and also comply with standards to ensure that we are able to get the most out of it. Because digital financial services is the key, is a way to go, is a way to mobilize revenue, is a way to enhance productivity, is the way to get people to work without wasting too much time. And I think this research actually provides the grounds for further work to enhance our knowledge in this area. Hello, Rosalind, can you hear me?
That's something we. Can you hear me? My sincere apologies if I'm breaking a bit. We have a bit of an internet issue in the office. So, Edwin, from a regulator's perspective, how do you see the analysis by William? We know that pricing is at the center of market conduct supervision to make sure that providers are not taking advantage of consumers. Sitting at on see this tool and the evidence coming out from this index, and how do you think regulators can use it moving forward, especially in the area of consumer protection and market conduct interventions? Edwin. Hello, Edwin.
Yes, thank you, Rose. Just confirming that you can hear me. Hello?
Yes, we can hear you, Edwin.
Yeah.
Okay, perfect. Okay, thank you, Rose, for the introduction, and thank you for the question. And also thank you to William for the presentation. And also thank you for clarifying that Tanzania has done some changes into its tax policies. So the data that you showed was in 2022, I believe. So we believe that there's going to be changes if you come for another session for research. On to Rose's question, from a regulator's perspective, this study has a great potential to be used, just like you said, to help protect the final consumer. And this can be done in several ways. The first way that I've seen is identifying areas where there's barriers to the adoption of digital financial services. So this study, I think it has highlighted the areas where there's barriers to the adoption of these financial services. Such things as it is seen that in rural areas, the availability of the agents was an issue. There was also an issue of overcharging, and just to mention a few. So all these barriers, this study will help regulators to know and pinpoint the areas where to focus on, so as to remove these barriers and potentially help the quick adoption of digital financial services. So the aim of a regulator, especially here in Tanzania, as for the Bank of Tanzania, is to ensure a cash-light economy in the next 2 to 3 years. And this can only be achieved by, since we know that in most African countries, especially in Tanzania, most people do not have access to bank accounts. So most people have mobile phones and they use those to do mobile transactions. So the only way that we can achieve this goal is to ensure that the environment is inclusive, that everyone can participate in performing mobile transactions. And the only way this is going to be possible is if these transactions are affordable to the end consumer. So one way is to identify the barriers. A regulator can, this study can help regulators point the areas where need action, so that these barriers can be lifted and eventually help a quick adoption of these mobile services. Next is on policy formulation. I think William talked about challenges such as overcharging. There's also an issue of mobile agents not being present, or issue of a transaction failing just because a mobile agent maybe did not have liquidity to help facilitate the transaction. So all these can help regulators to form policies that can be helpful to the mobile operators, to enable them to have a more conducive environment, to enable them and their mobile agents to be able to perform the services. Next is on and the final point is on cross-border comparison. I like the study because it includes countries across different continents, and this tool can be helpful in enabling regulators to be able to compare themselves to see which areas we're doing well or which areas need more improvement, and we can learn from one another, so that in the end we may all have an inclusive and thriving economy.
Thank you.
Over to you, Rose.
So now we can hear from the commercial perspective. Alex, you're always on the field. By William, surprise you? Is this something you think you are familiar with, the evidence coming out of the index on transaction costs? And looking at it, how do you think you as a commercial provider, an e-money provider, can use this tool to address some of the challenges consumers keep pointing out in the area of transaction costs in their engagement with agents? Alex? Do we still have Alex on?
Yeah, Alex, I think you're muted.
He's muted.
And thanks to all those who are posting questions. We encourage you, if you have more questions, please feel free to go to the Q&A icon and put your question there. Thank you.
Can you hear me, Rosalind?
Yes, Alex, we can hear you. Yes.
Very good. No, thanks. Thank you for the submissions, and great thanks to William for sharing the findings. First, I would like to align myself to a number of findings that he has shared with us this evening. A little bit surprised in terms of magnitude, especially the cost of waiting and the amount of time a customer waits at agent outlets in this market. I know for a fact there is an element of waiting, but that magnitude of time is what has sort of surprised me. I mean, in my rough estimate, I would take maybe 20 minutes as the longest period of time, duration rather, that someone will wait for a service. But here comes a finding that it may stretch well over that. So that to me is indeed a surprise. But other than that, I align to his findings that we have real costs that a customer experiences at the agent, one of which are fees, where some agents tend to charge or levy customers over the counter for some services, not all services. I think I'm a little bit surprised about cash out, but I know for a fact there are cases around bill payments that are assisted through the agents. So a whole range of assisted payments provide an opportunity or an avenue for agents sometimes to freeze or to be unprofessional in terms of serving our customers. And this is on the basis that some of the customers probably have literacy issues, they're illiterate, and therefore would typically require the support of the agent in completing their desired transactions. So that is an area that practically requires some solutions from us operators to be able to overcome. But indeed, it's a reality that we do observe in the market as a pain point to our customers. When you do maybe urbanicity versus rural, it is even more prevalent in the rural where the literacy rate is much lower than in the urban areas. So I'm sure in the results that William showed, he didn't display the difference or the contrast between urban and rural. But if he did, it would come out quite visible that in the rural it is more prevalent than in the urban. So I again do align myself with his finding around that, but largely I think it's common around what we refer to as assisted payments, where agents assist those customers to complete transactions that they are not able to do and complete on their own. And that is common across that demographic that is not able to read and write or initiate transactions and complete on their own. The other key finding that is living in the market is that of liquidity. There is a real challenge that most of our agents, probably well over 50%, tend to be undercapitalized and therefore tend to break most of the transactions that customers would like to do into more than one. For example, a customer would present him or herself at the agent wanting a float of, say, $300, but that will be broken down maybe into 2 or 3 because the agent at the time does not have sufficient liquidity to serve the customer. So sometimes the agent may have to make a number of phone calls from a peer agent to be able to receive more liquidity, top up liquidity, and in the process end up breaking up a transaction. And that is a real challenge both in the urban, but also in the rural areas. Now, as practitioners, as OPCOs, as operators, we're trying to ensure that we have better vetting of the quality of agents that we bring on board to serve our customers, and ensure that they're well capitalized. The second aspect that we're looking at is to actually look for ways of having these agents assisted. For example, having loans that they can partake of and be able to capitalize their businesses, because they're critical in our ecosystem to ensure that as MTN or any operator, indeed we do thrive in the business. So liquidity is key, and also practices of breaking up transactions is one of the realities that we see and relate to in a market like ours. Maybe regulators also have to come in, especially some services that agents tend to assist. because in some cases, agents actually volunteer to assist customers and in the process take advantage of that to levy unnecessary fees that are not lawful. But these are issues that we tend to share frequently with the regulator so that they have proper visibility on what services customers are being assisted upon, and therefore there is a window of vulnerability for getting overcharged. So for now, I think I'll stop at that. But yeah, I mean, I do relate largely to great findings that are being shared by William. I still remain a little bit surprised by the length of, or rather the duration that a customer would typically stay waiting for a service at the agent nonetheless. Thank you. Back to you, Rosalind.
Thank you so much, Alex. Those were very insightful contributions from you there. So let's get to our audience. If you want to ask a question, please do feel free to use the raise hand icon. But we have some questions in the question box that have been answered, so you can always go back to check on some of the questions that have been answered. We have some open questions, so I'll call on William. William, so Heather wants to know if you did a survey on people's perceptions of cost and perceptions of mobile money in general by they having adopted it prior to the study. And we also have a question by Anthony, which goes to Professor Quartey. And he's asking, the issue of enforcement of regulatory directive is very key. Where regulation is not seen to be doing enough, how could this be redressed? So William and Professor Quartey. Thank you.
Sure, I can address the first question. We did not do a separate study or survey on this, but we did ask consumers. I didn't present the results of this, but we asked them about the prices. You know, their awareness, their knowledge of prices, and so we can look at this to see if consumers are well informed, have the knowledge that they need about fees, or if their information is relatively limited, and so it's critically important for price lists to be made available and verbal disclosure to be done. So we have that data. We haven't looked closely at it. The other thing to mention, we're doing work actually in Tanzania trying to better understand consumers' price elasticity. So or price sensitivity, how much does a change in price affect consumers' willingness to use these products? Because we know that that's very important. At the beginning, I said that consumers will respond to changes in prices by increasing or reducing their usage, but we don't actually have good data on how large that effect is. But we are doing work on that at the moment in Tanzania.
Thank you very much, William. Professor Quartey, on how can the challenge about regulation not being seen to do enough be redressed?
Yeah, I think that's a very...
And just to remind you that we encourage you to post your questions in the Q&A icon, as we don't have the raise hand feature. Thank you.
Yeah, that's a very interesting question. We know in almost every country there is a consumer protection agency. So I think one of their role is to ensure that we consumers get value for money. So one area is to channel our grievances to the Consumer Protection Agency to ensure that regulators enforce the law. As for laws, I think we are good at making laws, we are good at providing regulations, but enforcement is a major challenge, and therefore we have to demand that through our consumer protection agencies. We have media freedom. The media highlights a lot of these problems. So I believe even this presentation, I believe some media people are listening and they will take this up. But we have to do more. We at Refined would also carry on this the summary from this discussion forward through the media so that our concerns are addressed. Then citizens can demand accountability. I believe we as citizens can write to the regulator, can petition the regulator to ensure that they enforce some of these regulations. Otherwise, such a useful service will elude us, given the challenges and the lack of transparency issues. Lastly, as consumers, we have the consumer power. You have the power not to demand, you have the power not to use the service. But that will be the last resort. I don't think we should get there. So there are various options that we can ensure regulatory enforcement. Thank you.
Thank you, Prof. Quartey. I think we have one here for William again. Okay, someone was asking about the question about the willingness to pay. Were you able to study or get some insight on the willingness to pay, even overcharged rates? We have from David Otoo. David wants to know, and David is a key player from the commercial side networks, and he wants to know from William if you ascertain throughout your survey the ownership of the outlets and how that affected the differences in the charges. So is there any relationship between ownership of the outlet and transaction costs or the charges, the kind of charges they have on the DFS? Great.
Sure. So I
William?
actually just yes, thank you. I just answered the first question in the chat, but just to summarize, we are measuring this willingness to pay for additional fees in a separate study in Tanzania at the moment in collaboration with Bank of Tanzania. We're not separately looking at willingness to pay for extra fees. I think that could be quite interesting. There may be, behavioral reasons why people would be less willing to pay for fees if they're considered, illicit or extra. But we don't have current plans to look at that, though I think it'd be quite interesting. On David's question, in terms of ownership, I'm not sure exactly what this means. We do collect information about the types of agent locations. So, the characteristics of the agent. Is this a agent sitting under an umbrella, or do they have an actual physical structure? Things like, are they a dedicated agent? They only provide agent services, or are they actually a shop that provides other services as well as being an agent? And then we can look at differences in overcharging rates by those characteristics. We don't have those results yet. But again, I'm not sure if that's answering the question around ownership. David, if you wanted to clarify, I'm happy to address that further.
Great. To Alex, can we have you back? Most of this transaction costs we're talking about are from the agent's point, and the agents represent your retail point. Coming from the commercial side, what interventions do you intend or are you putting together to address these pain points that cause the agents or that push the agents to maybe go beyond your listed cost of transaction? Because definitely the extra they put on is to address an issue, to address a pain point. As a commercial provider, as the one they are retailing for, are you interested or are you taking steps to address the reason behind the increase in transaction costs above what you have stated? Alex?
Yes, Rosalind. Yes, Rosalind. From a commercial operations point of view, we have a number of interventions that we are rolling out because first, like I indicated, we are aware of some of these malpractices that end up paining the customer and hurting the business. So whereas we have off-roll teams that engage our agents, still some of these vices continue to happen. And so what we've done, for example, is to have some sort of an audit team, what we call agent quality management team, that is not there to drive sales or to drive acquisitions, but basically to ensure that the agents actually adhere to correct practices from a compliance point of view. But also, number one, they are knowledgeable. They are sufficiently knowledgeable in terms of the products that they roll out and serve our customers. So yes, we have agent quality management systems, which is more of an audit arm of our operations, to ensure that they stamp out these vices that agents may exhibit in due course. And of course, there are penalties that tend to be severe, including blacklisting these agents and kicking them out of our supply chain.
Thank you very much, Alex. Can we hear from our regulator here, Edwin? We know that as a regulator, you want to set the guidelines for the commercial providers to play in. And normally, you don't want to really intervene in how commercial providers engage with their agents. But we have emerging evidence points to the fact that some of these increased transaction costs are related to maybe the agents not getting adequate compensation, and hence to cover their cost of operation, they are forced to increase or institute this on illegal transaction costs. From the perspective of a regulator, do you think it's time to move in more or to become more active in the relationship between the commercial provider and their agents on the ground? Because at the end of the day, when they fight, it's the consumers that suffer. Do you think it's time for the regulator to go deeper into maybe facilitating the relationship between the agents and their providers, their commercial providers, their e-money providers? Yeah.
Yes, thank you, Rose. Definitely, I agree with you. It is high time that these commercial companies deal with their agents, since the failure of them abiding to the laws will eventually lead to penalties that maybe the companies will eventually suffer. So it is, we are currently engaging in many conversations with many of the companies here in the country, with the mobile companies here in the country, and several policies have been made to ensure that the agents are aware of what they're supposed to be, of their duties, of how they're supposed to engage with the customers, on how the, for instance, how they're supposed to be to list the transaction costs, to verbally disclose the costs that will be associated with each transaction, to assist with maybe the elderly that may not be able to, may not have the complete knowledge on how to perform these transactions. So all this conversation is going on. And yes, the commercial companies are aware of this. They are aware that some agents are taking advantage of the customers that don't have the complete knowledge on digital financial services. So yes, the regulators, from our perspective, we're pushing that these companies be able to educate all their agents from the point of recruiting the agents all the way to hiring them. So they should be able to serve the customers according to the regulations and policies that were kept in place.
Thank you, Edwin. And to conclude, let's come back to you, William. So after such an insightful presentation of evidence from 3 countries, I think many of us will want to know what next. How do we take this forward? How are we taking the transaction cost index forward? How are we going to make it relevant to both policy and industry? What's next for the transaction cost index?
Sorry, thank you. Yes, it's a very good question, and it's pertinent because this is, we are wrapping up our data collection. We did a second year of data collection just to refine our methods and get some time series data in the 3 countries that we are working in, so that we can measure any potential changes over time. But as I mentioned in my presentation, I hope and we hope that this is really just the beginning, because these 3 countries show some interesting results, but one key finding is really that there's a lot of country variation. What's happening in Bangladesh is not super predictive of what's happening in Tanzania. And so that tells us that doing this in 3 countries is not enough. And so if you want to know what's, the issues that are most pertinent in Ghana or in Pakistan or any other country, the work needs to be done there as well. And so we hope to immediately output, along with our year 2 results, a toolkit that describes each of these approaches and the pros and cons for each, as well as approximate cost in terms of resources needed to do this work, and then share that with regulators that are interested in measuring these outcomes more systematically over time, as well as service providers that are interested in improving the quality of the service that they deliver and really competing on not just official price, but also levels of compliance with those official prices and the service reliability that they can deliver. So we hope that this that this serves as sort of a pilot for a longer, larger scale engagement where we can improve our measurement of these important outcomes.
Okay, so we'll be looking forward to hear more. And should we I was muted, sorry. I said we should expect to hear more from you on the transaction cost index. So fellow audience, we'll have a short poll before we call it a day. So Lauren.
All right, everyone should be able to see my screen. If you could follow the directions here, you can either go to the link here, or you can quickly scan this QR code with your phone, and we'll have 2 poll questions that would be great for you to participate in. So I'll give everyone another 30 seconds or so to go to the link provided. And thank you again for everyone who attended today. If you have any last minute questions, feel free to pop those in the Q&A. We can try to send around answers afterwards, or you can always reach out to us at financialinclusion@poverty-action.org. All right, let's move on to the next slide. All right, so one question we have for you all is, what is one word you'd use to describe this webinar? And as you, oh, sorry, Willie, you're saying it's not working for you? Okay, there we go. It should be on the next slide now. Feel free to drop in your words, and this will populate a word cloud to help us all see, like, what is the most common theme of today's webinar? What have you learned the most, just in one word? So we're seeing enlightening, transparency. Yeah, we know transparency is especially important given all the hidden fees that we highlighted today. Inclusion, obviously financial inclusion is the main goal of this tool. Insight, collaborative. Amazing. Thank you all for these inputs. They're really helpful, and we can share this word cloud afterwards as well. We'll probably post it on Twitter. Enlightening. Seems like insightful and informative are some of the biggest things you all are feeling after today. All right, let's move on to our last question here. I'll give everyone another couple seconds. Thank you to everyone who responded to this. It's really helpful for us. Last thing we have to share with you all. That's the question is, how would you use this tool in your work going forward? Whether you yourself are a regulator or if you're a researcher looking to work in the consumer protection area or you're already working there, how would you use this tool to help further your work or the research that you're working on? And I'll give everyone a minute or so to type in your responses, and feel free to write more than one word here. Great, cross-border comparison, that's an awesome submission here. And I foresee that most of these answers that you provide are areas that we're interested in exploring as well. So if you all are interested in partnering on TCI going forward or want more in-depth presentations on a specific country, feel free to reach out to us and we can definitely do that. For comparison, a great starting point for future research. We agree, we're really excited for our year 2 results to come out. Identify challenges facing agent businesses, work to reduce the cost of waiting at the agent and improve customer experience. Absolutely. Market analysis. These are all great. Yes, definitely gender comparisons, improving customer experience, increase adoption of mobile money. This is great. Thank you all so much. I think that's just about it for our webinar for today. Feel free to continue to drop in your answers, but thank you everyone for attending. We really appreciate it. If you have any questions, feel free to shoot us an email, but I think that just about wraps us up for today. And thank you again to all of our presenters. All right, everyone, have a great day. Bye.
Thank you, Laurie. Thank you, everyone, for the time.
Thank you so much.
Thank you
for
so
sharing
much.
this piece.
Thank you, William. Thank you, fellow panelists. Thank you, IPA, for partnering with us. We are most grateful, and we'll carry the summary, the findings forward. Thank you, everybody. Have a great day.
Thank you, everyone.
Thank you.